I'm Nicholas Bornos of Capital Link. We are coming now to the conclusion of a wonderful two-day forum with terrific content and top panelists. And we are closing our forum as usual with one of the most thunderous, if I can call it like that, panels, the Analyst Panel, where we have the brain power of Wall Street analysts sharing their insight with us. And Robert Bugbee is the one who traditionally moderates this panel. I think Robert does not need an introduction. And I don't think that Omar, Magnus, and Greg need introductions either. I will turn the floor over to Robert. Robert, thank you for being a terrific moderator. And thank you, Omar, Magnus, and Greg for joining. We actually are going to have shortly Randy Giveans, to show how live our forum is. Randy right now is on the tarmac with his plane landing, and he will be joining us very, very soon. So Robert, the floor over to you, and thank you to everybody.
Thank you. I'm very pleased that Randy's become so successful that he has his own plane now. That's wonderful. Anyway, great to have everybody here and partaking in this. I think I'd just like to sort of start by sort of asking everybody, on the panel, because the panel's quite an experienced panel. This isn't their first time through a shipping cycle, as it were, and I just sort of like to ask them to sort of really sort of tell us where they think we are in the shipping cycle itself in general, and anything that interests them in the stage we're in, or how they think it could develop going forward. Perhaps Omar, if you would like to take that question first, that would be great.
Sure. Thanks, Robert. Yeah, and happy to be on the panel here with you and Magnus and Greg. I think obviously, Magnus, you've got the longevity. When I first came into this business, you were well established. But when I think back, when I first started looking at shipping, it was at the end of 2003, early 2004, and it was starting to take off. And it was kind of a culmination of maybe many years prior of a lack of investment. And sure enough, that lack of supply started to coincide with this big jump in demand. And it definitely feels like we're in that similar type of environment where all of us, we've seen the shipping market really since the financial crisis. It's been a tough time. The sector's consolidated. A lot of investors have left, and now we're at this point where the lack of investment has created a tight supply situation. And just as we're there, demand is now starting to improve across different different spectrums. So it does feel that it's just good old-fashioned supply demand. The demand story, I think, has been missing for some time. The supply had been cleaning itself up, but now the demand is there. And so it feels that when we look outwards, the strong GDP growth and tight supply are just going to continue to lead to much stronger earnings. And I think one of the compelling things for investors to look at shipping right now is simply that we've had, for the past decade or so, a real lack of interest. A lot of investors just left, and it wasn't necessarily because of shipping alone, but I think maybe more broadly, the whole energy spectrum, that sector just was sold off, and a lot of investors focused on other things. But now it seems that the investing pool is getting bigger. And when we think about these next, say, 5 years for shipping, it looks like the amount of investor interest and the capital availability seems likely to be much wider than anything we've been used to these past, say, 5 to 10 years.
Great. Magnus, that's a nice introduction he gave you there.
I know. So yeah, to add to that, and I think, looking at these cycles here going back 20 years, I mean, we had the big cycle 2000 to 2008. A lot of people got long these names and also got burned because everybody was heading for the exit at the same time. So I think the last 10 years been kind of a hangover, both from a supply and demand for the markets and also for the equities. So question is it different this time around? And when anybody say that about a cyclical industry, you got to be a little careful. But I think we're seeing, this cycle, as Omar mentioned, is more supply driven than the other cycle in 2000 to 2008, where there was a play on China and demand was growing exponentially. So I still think you have to be a bit nimble when you play these names. Typically, you make the best returns playing the early cycle plays, and it's more difficult to play the cycle towards the end of the cycle when cash flows turn positive and we're trying to just figure out how long this cycle is going to last. So I think currently, the containers and the dry bulks have made their moves, and the one stepchild left is the crude and product tankers, which they have made good moves here early on in the year. So they think they're just discounting a recovery, but we haven't seen the companies becoming cash flow and earnings positive yet. And I think that's about to happen in 2022. And I think we were on track here. And this the Russian invasion of Ukraine kind of threw a curveball to all the segments here. And I think the product tanker segment looks like it's coming out as a winner among all of this. So I think going forward, I'd rather play some of the later cycle plays like crude and products, and especially products, to get the most upside in the returns.
Greg.
Yeah, it's funny. I don't consider myself young anymore, but yeah, I guess having only covered the sector for, geez, I don't know, since the late 2000s, I guess on a relative basis, I'm like a spring chicken here. I think Magnus and Omar, kind of hit on some points. I think one of the things that investors that are out there, are maybe thinking about, and, Magnus touched on it, and people being burned. I don't think it's that investors are necessarily, not interested in owning shipping stocks. It's been really, and this has plagued the energy sector, to Omar's point, for a decade. These companies haven't been profitable, right? I mean, we mentioned dry bulk. Most of the companies that are, have resurfaced in dry bulk, were bankrupt a handful of years ago. A lot of these names have gone through bankruptcies, over the last couple cycles. And so I don't necessarily think it's a lack of interest. I think it's been a lack of cash flows. And as we look at, to Magnus's point, hey, if you're a dry bulk shipping company, you're generating cash flow, the companies are putting out dividends. That is what we would argue is the next leg of that trade. And I think it's been so long that, one of the things that we have dealt with over the years is sustainability, i.e., hey, rates went up last week. Okay, well, they're going down because it's unsustainable. And I think that, and hey, that mindset is a mindset that everybody needs to have, because there has been a lot of blood in the water in shipping investing, as well in a lot of other commodity related stocks as things pull back. All that being said, I remember back in, when I started in 05, 06, where people were calling the end of the cycle, and it took another 2 to 3 years and a financial crisis to really end that cycle. And if you remember, then China came back and stimulated and kept shipping going longer for another couple of years, which really created the challenges of last decade. So, I get things have moved. I wouldn't look at any of these sectors from a historical basis and say, oh, hey, dry bulk asset prices are up, so we're significantly overextended in terms of pricing. On a mid-cycle basis, asset prices are up, but looking at whether it's tankers and dry bulk, neither of those you would look at and say, wow, that Cape-size vessel today is just expensive on a historical context. It's not. It's expensive off of a trough context, and the same goes for tankers. So as I think about this, and trying to tie together what Omar said with the supply, it's a very interesting time to be looking at these stocks for both short-term and long-term oriented investors, because the next couple of years look pretty attractive from a supply standpoint. Now, we know we need demand, but I'm sure we're going to touch on that a little bit more throughout this call.
Great. Well, why don't you lead us off on demand then straight away, Greg? Whatever you want, any market you want, or general.
Okay, yeah, and just because it's very topical and it's something that we've been thinking about. We've been thinking about is what is going on in Ukraine with the Russia invasion and that war, and there's two sides of this trade, which is probably why it's worth talking about, because it is absolutely impacting the product and the crude markets, and it's also impacting the dry bulk markets. One of the things that we've been looking at is export, seaborne spot volumes from Russia right now, because Russia exports a lot of crude and/or products from products on the east, from the east into the Baltic, and crude into the Baltic. On the west coast, it's largely crude. And as we look at what's happening there, it is absolutely creating dislocations in both the product and crude markets. And it has only been a couple weeks, but this is probably going to create some opportunities for that ship owner and on the wet side that maybe is bleeding money, to maybe get back to profitability. We saw that more recently in products. Crude, a few things more need to happen, but I'm sure Omar and Magnus have more to add on that. So I'll pass it on to them to talk about either the dry bulk side or the crude or the wet side.
Magnus, your choice.
Sure. Yeah, I mean, I think we're all trying to figure out what the implications are of the upcoming sanctions, and I think looking at the oil demand numbers look like they're going to be down, this year, and same with supply, given the curtailment of Russian exports. So, question is, what sectors are benefiting from this? And I think just looking at it closely, it looks like it's very negative for crude tankers, and potentially very positive for product tankers, like I mentioned earlier. The IEA took their global demand numbers down pretty aggressively right off the bat, and I think they probably not. I mean, they're the benchmark in the industry, but some of the EIA and OPEC has not reduced their demand numbers yet. So I think the jury is still out on the demand side. But I guess historically, shipping markets have benefited from disarray, and I think they're as a lot of refineries now are scrambling to find feedstock that's going to create ton-mile demand going forward. So, I've seen some initial numbers here where the product tanker trade actually has higher growth numbers post sanctions than before. So I think that looks very interesting. As far as dry bulk, that's probably the one that's most impacted. And, besides the grain market, coal has seen positive implications, with coal going longer distances from Australia or South Africa into Europe. So that's also creating good ton-mile demand. But overall, I would say, there's a lot of uncertainties in the markets, and we'll see. But I would play some of the laggards, given the uncertainties, and especially product tankers would like that.
Omar?
Yeah, I'll follow up on both on products or on tankers and dry bulk. I think it's an interesting point Magnus brings up, and it is one of the biggest questions is, okay, this big jump in Brent and crude prices overall, what is that going to do to demand? Because coming into this year, we have been gradually improving, and there was an expectation from the IEA specifically that demand this year would actually get back to 2019 levels and actually average above that. And so with them taking their forecast down, it's created this question of, okay, well, what is going to be the ultimate impact of demand? What's interesting is, at least so far, historically, when we've seen a spike in crude prices, that's usually bad news for refineries. Refiners tend to, as Magnus, you're just saying, there's a scramble for any available crude. And what's fascinating, I think, at least over the past month, is that refining margins have only gotten even higher in this environment. So with oil demand improving, starting throughout the past, throughout the opening up from the pandemic, crack spreads in refining margins, whether it's in refining margins have been expanding, and really since November, December have been very high, but then after the war began, crack spreads only reached record levels after that. And that just tells us at least that demand is very strong at this point and is willing to pay up for that crude barrel. And I think that's really important that, usually say a month ago, most people would have bet that, okay, crude has spiked, refineries are going to struggle to make money, but they've actually been making a killing. And we've seen record refining margins in Europe, record refining margins in Singapore. And that's why we're seeing product tanker rates where they're at, from LR2s down to MRs and handies. They're all earning well above 20,000 a day. It's because refineries are being compensated to make this product and the demand is there. Now, how long that lasts, we'll see. But thus far, consumers are willing to spend the money. And so that's I think just a good thing to highlight, at least in terms of why we're seeing such a big increase in product activity. On the dry bulk side, I just wanted to highlight that I think it's really, in my experience following the dry bulk market, I don't think I've seen it this way, where you can have a record, sorry, not a record, but you've had in 2021, the best year since the 2007, 2008 time period. And that was all without the help of China. I would say China and dry bulk have been synonymous as far as I've followed shipping. And a lot of investors have simply looked at dry bulk as a play on China. But if there's anything that the past 15 months have told us is that, well, dry bulk seems to be detaching itself away from China, and that it can still have a very strong market without it. And it's just, as Magnus mentioned and Greg mentioned, the longer ton miles that are now developing as a result of Ukraine and Russia, that's only making it even tighter. But prior to that, you just had strong demand drivers outside of the whole steel and iron ore complex. So to me, I think dry bulk is actually in this transition phase that seems very interesting over the long term, that you may not need to have a very strong China to lead to a good dry bulk market. And I think that makes it a bit more compelling, and especially for US investors who have tended to be a little bit more hesitant at making investments on a China case.
So thank you. So let's move a little bit to supply, and a little bit longer term here. And one of the things I think is interesting is just how much or just how little yard capacity there is going forward, and how shipyards now would have better things to build than simple tankers or simple dry bulk ships. And that's going to help. That's helping in valuations across the board in terms of that. So the containers and the LNG markets seem to be pretty important in terms of keeping yard pricing strong, keeping capacity strong, throughout in the other markets. So, Omar, would you like to go first on containers and LNG, or anything else you like?
Sure. Yeah, just in terms of, sorry, Robert, containers and LNG in terms of demand for that, or just in the context?
Well, those markets, containers seems like red hot. If dry bulk is strong, containers has been, red hot, and billions of dollars are being made in the container market, and they've been nicely filling up the shipyards, and shipyards themselves are getting better margins out of containers than they would just building tankers or dry bulk ships. So can we see that continuing? How is the container market set here going forward?
Sure. Yeah, I'll happy to talk about that. Yeah, the container market, and as you mentioned, the billions that have been generated in the past year and a half, I think the whole industry has become debt free. And for a sector, for a whole industry to just do that in such a short amount of time, I think is pretty significant, because they were pretty levered coming into where we were. It's not like these companies had strong balance sheets going in. They had okay balance sheets. Some had struggled. Some were constantly in discussion with lenders. And now they're all either debt-free or in a net debt-free position. And so, yeah, they've been filling up the order book because the market has been tight on vessel availability. It does feel that there's maybe a bit of a tempering in those orders. You had a big jump last year, but over the past maybe 6 months, we've seen a slowdown in the amount of ordering activity. And it does feel like maybe there's a bit of a pause at this point as people try to assess what's happening long term with the market. Hey, Randy.
Randy, hi.
Hello. Hello. Can you hear me?
Randy, we can hear you, Randy.
Excellent. Sorry about that. I just landed. literally.
That's okay. That's okay. We were just starting to talk about, this is the, can the container market still keep going at the moment?
Yeah.
Yeah, that's certainly a question we get a lot on. I'm not sure what the previous panelists probably already covered it, but in my 2 cents, in terms of the liners, we covered jams here domestically. Clearly, what they're doing in terms of contract rates is going to be very buoyant. You're still seeing port congestion, inventories remain low. So there's a lot of factors that you could see higher rates for longer. On the container ship, the owner lessors, the now global ship lease, their revenue stream is basically locked in here for 3+ years. So multiples are still extremely attractive. So we are certainly pretty bullish on container shippers going forward.
Great.
I just punted it off to Randy. Robert.
Omar was saying that the container companies are now debt-free. Does that mean they're still shipping companies, or do they qualify as something else now?
Yeah, that's a rare breed. There's a few pursuing that same strategy.
Exactly.
The container shippers to that end goal.
Okay, Craig, maybe you could comment on what are we seeing in there's a lot of good things seem to be happening in the LNG market right now. Do we expect to see them to have a great demand to order vessels and keep the yards occupied or not?
Yeah, no, absolutely. I mean, and I think it's funny that LNG. If you look back, maybe pre-COVID, I think there were definitely some current concerns around the LNG markets, just given the slowdown in the startup of new liquefaction. And, it ended up being a tremendous year last year for LNG. And now, what's happened, and, hey, let's not kid ourselves. Russia supplies a ton of natural gas to Europe. And with what's happening and this potential, not even potential, there is going to be some diversification of the EU in their natural gas supplies. And you've seen it, right? I mean, even before this was happening, I think people, us included, were calling for a super cycle in LNG liquefaction, or really that next phase of LNG projects, whether that was in North America. Obviously, the Qataris are going to be ramping up. I think everyone on the board here covers Golar, which has its liquefaction, where they're looking to, maybe do another incremental project in West Africa, or maybe 2. So as we look at the diversification of EU and others for their natural gas, there are, we've already seen it, right? I think Cheniere's announced an expansion. Sempra was talking about expanding. Companies like Tellurian and Next Decade that are going to be LNG exporters out of the US, which were really kind of left for dead a couple of years ago, are getting a little bit of a pep in their step. And as all that capacity comes online, you are going to need you are going to need vessels to move those cargoes. So, yes, there was a huge run up in container ships, and yes, hey, there's been orders in LNG. But as we look out over the next 3, 4, 5 years, knowing that a lot of these new liquefaction projects are going to take a couple of years to get going, yes, I think you're going to need more LNG vessel orders, which, to your point, Robert, hey, if I'm a shipyard in Korea and I can build container ships or LNG, the margins on those vessels right now are a lot better than if I'm going to build a dry bulk or a tanker. So, I think that the longer term, supply dynamics for dry bulk and tankers continue to improve as these higher calorie assets, container ships first, which have filled up the order books a lot over, in the next couple of years, and LNG continue to kind of cannibalize those spots, at those kind of the major Korean yards, and at least, the higher end Chinese yard.
Right. Nicholas, I can't really see from my side, but I'd love it if any of the audience would like to ask questions, and maybe you could ask them for them if you see them, Nicholas.
So one of the questions that came through is whether oil and crude originating from Alberta and South America can overtake oil originating from Russia in less than 4 years.
Anyone like to take that one on?
I can start on that one, but first, can we hold the plane for another 15 minutes so I can do the Q&A session? All right, good. Just want to make sure that the plane is waiting for me. Yes, on the
you can join Randy on. You can borrow Randy's plane. So.
Right, I think he's in the wrong city though. But I think it would be very difficult within that. We said 4 years. You know, the problem with the whole oil industry is, you know, a lot of these projects that needed funding, you know, couldn't get funding, and a lot of it's been pushed back. And it's been a terrible place to be. If you're an oil company, everybody's telling you to be a green company. And a lot of these projects, some companies have taken it to an extreme and really sold a lot of their assets. And I think it will take some time. I mean, the near term supply, I mean, has to come from, you know, the Middle East. That's where most of the barrels are. And I mean, US shales should also ramp up here. You know, but we're going through this every day. You know, the current administration is not promoting, you know, the oil and gas industry, and you just don't need to drill for oil. You also need gas, you know, pipelines to hook up the gas or oil to transport it. So I think it's a very difficult environment to continue to raise production in the U.S. without a friendlier environment. So I would say near term, it will come from the Middle East. Yes, the shale is very important. And I think we could see another 1 or 2 million barrels of that. In 4 years, it probably could be more. But that's where, you know, we have the near term low hanging fruit. So, you know, if anybody else wants to care to expand on that.
No, Nicholas, let's have another question. I can see there's a bunch of questions. So let's take another question if we can.
Well, one of the questions that came through is, and we talked about it in another panel the other day, what do you think, I mean, crewing is one of the big also cost components of a vessel. Where do you see, what do you see happening with the crewing shortage? And is that automation part of the solution in the crewing industry, which I don't know if that's the case, but we have a cost increase coming with the short supply of seafarers. How do you think that the industry can cope with that?
Anybody? I'll take that one, Nicholas. The crew costs are just going to go up, and it's going to take a little bit of time to get further automation. But you know, crew costs are just going to go up for the foreseeable future.
We got another question.
Let's take the next one.
We got another question that has to do with essentially capital allocation. This particular question is phrased: this morning, the top 3 shipping companies in Japan announced a joint venture where they will spend 20 billion for boosting capacity, and their stock prices had a big drop. So is this the reaction we should expect when other companies using their extra cash? I would paraphrase it a little bit and maybe open it up to what do you see as optimal capital allocation for companies?
That's a great question. Who would like to take that one first?
Yeah, I mean, I guess I'll comment on this. I don't think that was today. I think that was about a week ago. And so what happened was, you know, I think one of the big issues has been, or I think he's referring to like, you know, NYK and MOL, which that was about a week ago when they announced that JV. You know, no, I think that is shows you opportunities, because, you know, as we think about that, you know, that the use of capital to build vessels, I think one of the big things that you're hearing, you know, and since I think somebody mentioned what's going on with DC policy, you know, I think you know, politicians around the world are looking at where prices are today, and unfortunately, I think it's not something that they're focused on, and so they look at what they refer to as price gouging or other. And I think, unfortunately, there's a lot of education that needs to happen in shipping, because yes, hey, container shipping companies are making money right now, and they're redeploying that into new assets, which they should, to make more money. I think what people forget is, you know, for years, some of the largest European liner companies in the world, you know, it was touch and go on whether they were going to survive. As you know, one French company comes to mind. They had to go to a Turkish private equity fund for a huge capital injection just so they could keep flowing, you know, money flowing. I think, you know, people need to remember that, the bulk of profits in shipping are made maybe for a third of the cycle, maybe another third of the cycle they're breaking even, and then the final third they're usually losing money. To us, what's interesting is, as we think about that, we kind of were in this multi-period of losing money. And so, yes, hey, last year was a good year for, a sector like dry bulk, but we would say we're still in the very early innings. And just to tie it to your question around capital allocation, Nicholas, I think some of those shipping companies in the dry bulk space are actually showing what they're doing, i.e. they use the recent strength over the last, call it 1 to 2 years, got their balance sheets in a position where they can, start returning cash to shareholders. And that's exactly what you're seeing these companies do. Whether, pick a dry bulk shipping company from Star Bulk to Eagle to Genco to Golden Ocean, and they've all been turning on that dividend spigot. And so I think, and the stocks have done well in response to that. So in terms of capital allocation, I think it depends where you are in the cycle. But at least where the dry bulk cycle is, that capital allocation strategy, I think, is going to be one largely of dividends and buybacks, at least in the near term.
Great. Next question, please.
Well, you actually opened the door to the next question. And I have one of my own that I'd like to ask later on. The question that came through is how advisable, in a way, or sustainable are the dividends for the dry bulk companies? Some of these now, some of these payouts produce a very high yield. And that ties back with your point that profits are made for a third of the cycle only. So now that you have all this huge money coming in, how advisable?
Okay, great. Let's try, if we can get Randy, let's see if your reception's a bit better. You could take that one.
I'm afraid that Randy has dropped off. Apparently, he must be off the plane.
Okay, Omar.
Sure. Yeah. Well, definitely, the dry bulk companies have all, I think, for the most part, created dividend policies that are "quote unquote" sustainable through the cycles, because it's based off of a percentage of earnings or a percentage of their cash position. So I think that there is there's a real willingness on the part of the companies to pay out cash. I think pretty much even Diana, which was the laggard in terms of wanting to repay capital, rightfully so, because free cash flow hasn't been generated to a meaningful degree for many years. They're starting to pay out dividends, but for the most part, they've created a policy that allows them to make it toggleable with where rates are, and that creates some variability, which probably at the end of the day doesn't necessarily attract a wide long-only investor audience, because they tend to not prefer a gyrating dividend, but it is one at least where they're paying out the cash that's being generated in a healthy market, and they're able to continue to generate cash and not have to worry so much about having not allocated capital to debt repayment. So I think that's a positive situation. That one comment I would make about it overall is, clearly the investor base, and people may have heard me say this before, clearly the investor base in shipping wants that capital back. That's at least a sizable amount of investors wants that capital back in a healthy market. But I'm not so sure that actually needs to happen. And when you look at, say, Danaus as an example, one of the best performing shipping stocks in a thriving container ship industry, that stock has done very, very well, despite everybody asking and begging and hammering them for not ramping up the dividend to a meaningful degree. The stock's over $100, and I think the dividend may be $2 or $3 annually. And so they have the capacity to pay out a big chunk, but they're recognizing that there's a lot. First off, there's a lot of uncertainty. We had no idea what the future propulsion looks like. We don't know how long the cycle is going to last for. And we just came out of a decade worth of lenders beating us over the head, telling us we can't do this, we can't do that. And so I think that there's something to be said for retaining the cash, holding on to it, because you don't know what the future holds. And it doesn't seem that investors really reward you at the end of the day for paying it out in the first place.
If I may interject on that one, and of course, I'd like maybe, Robert, if you don't mind, to have your take on that as a major owner. I'm looking at two people. I'm looking at a ship owner, and the ship owner is facing the necessity for fleet renewal, and the ship owner is in this business forever in a way. And then I'm looking at an investor, And the investor would obviously like dividends because dividends create better yield. You get the reward for being a shareholder. So if I'm in the middle, what is the optimal policy between achieving sustainability and fleet renewal and competitiveness for the long term, because that's what I do as a shipping company, versus rewarding an investor who is happy today getting a high dividend, and then he will be gone tomorrow because investors are, in a way, migratory birds. So what is the medium ground that makes everybody happy and makes things move? Randy is coming in, but I think he didn't hear the question.
Okay, so Nicholas, I'll answer. I don't think that the world works in, there is no happy middle ground. You just have to accept that, you know, shareholders are, you know, they rent stocks, whether they rent them for 5 years, 7 years, or 5 minutes or 7 days, you know, they want their return. And you know, they'll figure that if they get the money back, it's a cyclical industry, so they will always want to have their money back or their ability to sell at one form or another. That's what's shown. And so when companies pay out the dividends, then so far the industry, when they do that, you know, that keeps the capitalizations down because we give out the dividends, and few of the public companies have the real cash. If they had kept their dividend, kept everything for the downturn. Like a private owner. A private owner is different. A private owner keeps all the money and reinvests it later.
Thank you, Robert. That was very well put.
I mean, the only happy, the happy medium, for example, is a John Fredrickson, who's happy to pay out all the money because he's paying himself a huge amount of money too. As a primary shareholder, and he acts as an investor all the time.
By the way, the panel before ours was on capital markets, and I think it's interesting to see that despite the fact that all of these stocks have done so well, the capital markets activity in terms of capital raising has not been that brisk. Is that because everybody's very liquid and they don't need more money?
I don't know, but nothing. I don't think anything has changed. I remember the last cycle. The choice at the end of the last cycle was either you go into a full payout dividend mode, like Frontline or NETI, or you sell the company. Those are the two choices to create the maximum return for shareholders.
Well, I would also add to that. I feel like when I think of the dividend story, it feels like that was something very much last cycle as a sector, in my experience, didn't have that much, there weren't that many companies represented on the stock exchanges. And there was a big opportunity to attract investors and say, hey, listen, invest, and we're going to give you back 50% of our cash flow, 100% of our cash flow. Mm-hmm. And the debt wasn't amortizing for the 5 years anyway. And so every ounce of cash flow we're going to generate, we're going to give to you. And that obviously created this problem. But I think the dividend story from 15 years ago, I think, was one to attract capital and to get these companies listed. And now they're here. Now there's many companies listed. I don't think the dividend is really that necessary over the long term. Clearly, yes, some dividend, but in my opinion, a management team that focuses on trying to always run the business on the premise that they want to pay it to shareholders, I think that creates a problem because you're, as you said, Nicholas, you have investors who can sell out of the stock tomorrow, and you have companies that are going to exist for a long time. And how do you manage that? Because you have to think about the long term, and if you're giving it all out, you're stuck holding the keys when the investors are gone.
I think Robert used a very pragmatic and realistic phrase that investors rent the stocks. And that is the function of the investor, to invest today in one stock and then tomorrow go to another and generate returns by moving in the proper direction over time. So anyway, one other question that came through is we have seen the stock prices of most companies go skyrocket, but still a lot of them trade at the discount to NAV. So what accounts for that?
I think historically these stocks typically trade at a discount during the recovery phase. I think if you look sector by sector, I would say dry bulk has probably most of the names are not trading at NAV or at a premium. And I would think at the names that are trading at big discounts, it could be market cap, trading liquidity that's behind that discount. I mean, there's really no reason why they should trade at such a significant discount. And you would ask yourself if you should be public if you trade at a 60% discount to NAV when you can go out and sell that company in the private market, at 1.0. So I would say that the laggards there's still some trading at a discount, but I think as we move into the cycle in each segments, that discount will turn into a premium.
Yeah, and chiming in here, I think part of it is the discount is either due to investors thinking asset values are inflated and got to come off, right? So your NAVs are going to come down, or there's a management team discount, which is certainly prevalent in a handful of management teams. Or then obviously, as Magnus said there, somewhat of a liquidity discount or a market capitalization discount, and kind of those are just taken care of through consolidation, or obviously increased earnings help with that as well. So there are some reasons for the discounts to NAV. Now it's not rampant, right? As you mentioned, there's certainly some names that are trading at NAV or not at premium to NAV, but clearly there are some that are still well below.
Yeah, and I would just add another thing. I think in the public forum, the reason that a lot of these stocks trade around that or NAV is because management teams run their companies at or NAV, i.e. whether they're looking at M&A. Let's find a company that's buying back their stock at a premium to NAV. And I'm not very familiar with that. If you're generating cash and you're trading at a 10 or 15 or 20% above NAV, and you're with your excess cash, you're buying your stock at a premium NAV, I imagine you would start trading at a premium to NAV. But I think that's one of the big issues where, well, we can't do this because of NAV, or we don't want to talk about NAV, but our NAV is too low. And so I think and hey, NAVs are very easy to calculate yesterday. I think one of the challenges is, stocks are forward discounting mechanisms. So people need to be thinking about where they think that NAV is 6 to 12 months down the road, not yesterday, using, like a Clarksons or another shipbroker quote. That's a yesterday price. That's not a next week, next month, next year price.
All right. Next question, please, Nicholas.
If I can ask this question, Robert, and clearly I think you are even more well-placed to answer that. The divergence, if there is any, between crude and product tankers, and what do we see about the two sectors?
Someone else can go first on that one.
Okay, of course.
Yeah, I think we already kind of discussed that with the situation in Ukraine. I think the crude, it looks like it's going to be negative both from supply and demand standpoint, whereas the products I've seen, as refineries scramble to find feedstock for the refineries, that product has to travel further distances, and that creates a good ton-mile demand growth for the product tanker sector. So I think there's definitely a clear trend for those two sectors.
Yeah, and then just I would chime in real quick, and it's something that I think has been surfacing over the last few quarters. Actually, is everybody's very interested in getting back to pre-COVID crude oil demand, i.e. when is OPEC going to get back? And I think people need to remember that, hey, that's great that we're trying to get back to pre-crude oil demand, but the crude oil tanker fleet is larger today than it was 2 years ago, where product tankers, you can kind of look and say, oh, those refineries in Australia are no longer there. That's incremental demand. Those refineries, that were 2 refineries in the U.S. coast, are shuttered. And so as you look at the refinery network globally, that has changed and really created opportunities for products as opposed to the more simple equation of crude. And I think that's one of the things that's driving that, whether we call it dislocation relative to each other or outperformance of products over crude.
Great. Nicholas, next question, please.
If I may ask a question, the following question. We see, let's go to the LNG. That is one of the big topics of the day. we see on one hand all these declarations about getting a decreased dependence on gas coming from Russia. On the other hand, we see the US now is going to start shipping a lot more LNG to Europe. We have FSRUs and other facilities being built to accommodate that. So what is your take in terms of the LNG sector, and can that lead over time to really a geopolitical realignment and complete change on the traditional source of dependence for gas?
Well, I'm happy to start that one. I mean, I think the LNG shipping sector is a very interesting and compelling one now, where it probably is at this point regaining its position as the fastest and longest term growing shipping sector, right? It had a high growth period, and then it went through a really tough time as LNG and natural gas were kind of tossed to the side almost, or forgotten about and lumped in with crude, and there was a lack of investment. And then sure enough, you saw a lot of the public shipping companies and the public LNG companies having a hard time raising capital. And then of course, private equity went and took them private, whether it's, GasLog or TK LNG, some big names taken away from the public markets. And sure enough, now there's broad recognition that, LNG is going to be the way forward, because that's a supply driven market. Natural gas is a huge market, but LNG maybe makes up 8% or something like that in terms of the amount of gas that's consumed. It comes via LNG. So the LNG, when it's available, it will be moved. And as you mentioned, Nicholas, the landmark agreement between the U.S. and the EU. I mean, it's going to create a huge amount of LNG. If we just think about it in quick numbers, the trade is 400 million tons a year of LNG. The U.S. has at this point 200 million tons in the pipeline. That's in the approval phase. Those are likely going to get fast tracked by the existing administration. And now you've got, just from the US alone, from these projects that will start, in the 26, 27 era or period, that's 50% more capacity just from one, just from that. And then you've got all the projects from Qatar, as we discussed earlier, plus the existing projects that are coming on from, whether it's Mozambique and the US Gulf in general. So LNG is here for, it seems like, for a long time. And just judging by the way these stocks have been acting, there's a big pool of investors coming back into LNG, and it looks like it's going to be a sector that's going to be much more easily financeable than it has been over the past maybe 5 or 6 years.
Yeah, and to touch on that and to answer that question from our end, we're seeing anything gas related is certainly benefiting. I hate to use that word, but certainly being most positively impacted from this whole geopolitical tensions, the invasion, and these other things. Now, can the U.S. replace Russian gas to Europe? Not in the next 5 years, right? That's going to take a lot more time. We do think LPG exports could ramp more quickly and more dramatically in the near term, right, before the liquefaction facilities get fast-tracked and built. But all that being said, this is certainly arguably a permanent impact. Even if Putin and Zelensky and whomever come to an agreement today, I don't think Europe says, oh, okay, good, thanks for being our friend, Russia, we'll take your gas again, right? So this is going to be a very long-term impact, and it's going to be certainly beneficial for the gas shippers, both LNG and LPG.
Great. Next question, please.
I think we are coming to the close of questions. I wanted to ask you, ESG is one of the topics that has been, I wouldn't say beaten to death, but, has been discussed widely. How prevalent is it in investors' mind right now? I mean, are you getting a lot of questions? In your opinion, when somebody wants to invest in a company, particularly in today's environment, is ESG one of the first topics they're asking, or is that, I mean, it's something that they have to tick the box and...
I think there's been...
Go ahead, Magnus.
I think there's been a change, definitely a big change in the last month, with the events happening in Ukraine, where really people are realizing that we may have gone a little fast into this ESG, and that we really need all resources to meet strong energy demand going forward. And I think in particular, the shipping industry has done an excellent job in reducing CO2 emissions. And I think you know, have realistic goals, maybe pushing a little too hard. But I think, you know, as far as the shipping sector has done a great job. And I think as far as investors, I think there's a little rethink now that maybe some of these older industries, you know, are coming back to life again and needs to be revalued. And maybe, you know, I mean, I'm sure each investment company have their guidelines, but you know, maybe not so tight going forward as far as ESG, because it was kind of like, if you look at the S&P 5, the energy component of the S&P 500, I think it was below 2% at one point in time, and I think that's going to increase going forward.
Yeah, and as Magnus was saying, I think like with Europe, right, who kind of went too green too soon, maybe. I think some investors are realizing that as well. So ESG is certainly not as prevalent of a topic as it was maybe 6 months ago, a year ago. But also when it comes to shipping, it's a little hard to qualify, much less quantify ESG, right? I think the E, carbon emissions, you know, 3% a year, whatever it may be, you can target and hit those goals. On the S, on the G, it's arbitrary, right? It's pretty subjective metrics. So as Magnus was saying, yeah, I think there's certainly been a pullback in that. Oh, we got to focus on ESG in the near term. I think there's other bigger fish to fry.
Yeah, and I would just say something real quick. I mean, you know, it's, hey, an attack on Ukraine and the sanctions of Russia absolutely have people reevaluating. But I mean, you know, and I think you know, was the pendulum swung too far in the one direction of ESG? Yes. Has the pendulum swung too far? That doesn't matter. I think that's probably where we are today, Nicholas. You know, if you just look at carbon prices in Europe, you know, Ukraine gets invaded, carbon prices are down 40% in like a week. Now, carbon prices have since rebounded 40% in a week. The problem is 40% down and 40% up still leaves you down from where we were. But ESG investing, you know, is here to stay as it pertains to shipping. To Randy's point, you know, there's the E, there's the S, there's the G. You know, one of the things that as it pertains to shipping is any E in terms of, you know, lowering carbon emissions. Probably what that means where we are today and in the near term is that could lead some vessels to maybe go a little bit slower to try to maximize their, you know, fuel efficiency. And that's clearly a positive for overall shipping supply demand. But, you know, I think it's something to keep an eye on. I don't think anyone says, hey, I'm an ESG investor and then's going to go run out and buy an oil tanker company. But it is something that they're aware of.
I would also just, Nicholas, one final point on that is the derivative of the E, of the ESG, is it doesn't seem like it's getting that much focus, but it could be something that starts to really capture investor attention going forward, is the eco portion of it, because you do have, for the first time since the eco-design ships have all delivered, is a high oil price environment. And you've also got, for the first time since the scrubbers were installed, a high oil price environment. And so the net TCEs that these companies are going to be able to capture are going to be widely different. I think when we think about the second quarter onwards, where, you know, we see headline VLCC rates at 0, but an eco ship with a scrubber might be getting something like 15. Not a fantastic rate, but a real separation. And you see that across the different asset classes and different sectors. So you may start to have investors focus a bit more on the eco aspect of the ESG. When the companies, as they report numbers, all start to have very different figures.
Great, gentlemen. So we stop. Do you want to stop there, Nicholas?
Yes, absolutely. Maybe one last question, Robert. Last time you were very kind to moderate 2 different panels of analysts, and the idea was we moderated the panel that was opening up, if you want, the shipping to a broader retail environment versus, you know, the traditional analyst universe focusing on the institutional community. So I wanted to ask you, do you see the interest today coming from an expanded investor group, and how do you see the investor dynamics today? And that would be the concluding question.
I mean, there's no question that it's expanding. No question. I mean, many different ways. We see, you know, the analyst industry itself was a little bit in crisis in terms of shipping, you know, 3-4 years ago, but now I think it's very healthy, very strong. You know, there's lots of covering analysts, and the investor appetite is, you know, is increasing. And but there's no question that the subscription or the or even the amateur analyst just blogging in Twitter, etc., is increasing every day. And some of these chat rooms regularly have hundreds of people in them, and I think that's there to stay. And I mean, one thing I think that I find is particularly irritating, and it's not the analysts don't make the rules, but I think that when a company is giving a presentation or a chat with one of the banks, so if for example Scorpio Tankers was doing a non-deal roadshow and a conference call, open conference call to investors with a bank, then I understand that it shouldn't be live to everybody. But what I think should be allowed is that the bank allows that company to post the recorded conference, maybe 24 hours, 48 hours later. And I think that would help both sides. It would help get more investors in, and it would help the companies themselves. That would be a request to all of the banks. It's particularly irritating when you post that you're going to do a conference, and then you have lots of investors asking how they can get onto the conference or hear it, but that you can't get them on or can't show them a playback.
You have a great point, and if you allow me to, I work with all of you, and I'm grateful for your support and cooperation. But actually, Robert, we have followed exactly as your advice, and the company presentations we made are open to the public. Of course, we come from a different angle because we're not servicing a defined.
Yeah, no, it doesn't have to be on the day. It can be 48 hours later. Yeah.
Of course.
Well, anyway, that's just a request. So
I'm sure it will. All of the analysts here will listen to your request eagerly. So I wanted to thank you, Robert, for moderating this panel. I wanted to thank all of the analysts for joining us. And we can conclude this today forum. It's been a tremendous experience. And again, I'm grateful. Actually, the very first person I met when I started this business was Magnus, and then Omar. And of course, I developed a great relationship with you and Robert and Greg and Randy. So, but indeed, we go back such a long time.
Yeah, was that 40 years ago?
Sorry?
Nicholas, we thank you for what you have done for the industry. So we really appreciate that very much.
And thanks again for having me. Sorry I was late. Really appreciate being able to join.
It's okay.
We were all happy to know that you had a private plane and you could steer the tarmac to.
Not quite. I'm not at Robert's level.
Thank you to everybody very much.
All right, thanks.
All right.
Bye-bye.
Thanks. Bye-bye.